Nitin Rakesh of Motilal Oswal joins me as well. In a bit, we'll talk about the Midcap ETF, the country's first Midcap ETF, which will be launched by Motilal Oswal as well. Nitin, afternoon. Before all of that, your thoughts on this market? Do you think we are in a bottoming out process, or tough to say in the near term?
No, again, I think it's a very tough call whether we are in the phase of bottoming out or this is just another lull before the next round of storm. But again, if you look at it from a fundamental point of view, I think it does look like that we are getting closer and closer to an area where it's going to be hard to justify any further declines in the price action itself. So clearly, I think the market's consolidating, digesting all the news. The only thing that is very negative right now is the sentiment. Both from a foreign investor point of view in terms of the flows, as well as I think the domestic investors are a little worried about some of the headline news that we read every day. So I think it's really a wait and watch. Let's make sure we know everything there is to be known about the macro factors. Let's hope the political uncertainty doesn't really turn into uncertainty, and digest the quarterly numbers and really see how bad the impact of some of the macro issues is going to be. Will it be as bad as it's been expected, or if not, then I think we're then set for a recovery as well.
Just a quick thought from you on Wipro, because now all the frontline IT numbers are out and the markets reacted very differently to the different sets of numbers which came in from the large cap set, the top four. What are your key takeaways?
I think as a sector, we haven't seen any big surprises at an aggregate level. Clearly a lot of the price action over the last 6 months had already expected these kind of numbers. At an individual company level, I think clearly there have been some surprises like TCS, some disappointments from a guidance perspective like Infosys, but I think that's been very typical of Infosys price action post the results maybe over the last few quarters anyways. And then obviously I think the Wipro announcement about the change in leadership was a little bit of a surprise and shock to the market, and hence you see the knee-jerk reaction. So I think IT will continue to probably be in that double-digit mid-teens kind of growth, clearly led by some of the bigger names, as we've been saying over the last a few quarters anyways. So there's no real surprise. It's definitely going to ride on the recovery that we are seeing, at least in parts of the global markets, and should continue to kind of give us the kind of guidance that we've seen.
You're launching the Midcap ETF based on the CNX Midcap Index at a time where clearly the flavor of the season is not midcaps. People actually have lost money in midcaps November onwards after the corrections. So is it a good time to get in, and do you think a lot of confidence building needs to happen before people start gravitating once again to the midcap story?
I think it's there are two things that are key to note about the midcap segment as we see it. First and foremost, the only way to enter into the midcap segment so far has been to buy individual stocks, and at best you can go buy actively managed funds, and both of them have their own sets of problems. So I think for us the endeavor was to really open up the segment through an index-based investing strategy. So from that point of view, it's not really about the environment and whether we are going to see money coming in right away. I think the idea is to open up the segment broadly for investors to be able to buy the index. Secondly, if you look at the nature of the segment, absolutely, mid-cap stocks have been more volatile, have fallen far more than the large caps, especially in the last 2 months. But the way the index characteristics are, because it's a diversified basket of about 100 stocks, very surprisingly, the beta of the mid-cap index is actually lower than Nifty. The standard deviation or the volatility at an index level seems to be lower over a longer period of time. And hence, you're actually going to potentially get a product, or at least a segment, that has the promise of higher returns, as we've seen over the last 10 years. With potentially lower volatility. I think the trick really is, whether you're looking to buy it only based on trying to time the market, or you're really looking to make this as a complement to your large cap portfolios. And I think we definitely believe that, at a time today when the mid cap index is at a FY12 basis quoting at less than 13 price earnings, which is about 40% lower than the Nifty, it's really not a whole lot of downside risk left in the valuations at least.
Nitin, what have you made of the banking earnings so far? Both from the private banks and from the public sector banks, numbers seem to have been quite okay, but despite most of their stocks being down 25-30%.
No, absolutely. I think we've been talking about that on the show as well. Clearly the expectation on the compression on margins was overblown. We've seen a slight decline, in most cases 10 to 15 basis points on the net interest margins, but I don't think that justifies the amount of selling we saw in these stocks. So clearly, I think given where we sit, given all the current headline news that we read about, I still think that banking clearly is one of the best investment opportunities that has been given to us in this current fall. And I think it cuts across almost all categories of banks. But specifically, I think even the larger names, both in PSUs and private banks, are also available at a fairly good price right now compared to where they were about 2 months ago.
Nitin, you've gone through quite a bit of earnings season already. By the end of this week, we'll get a fair sense of what numbers are like for the current quarter. What do you think? What kind of note are we ending this earnings season with?
I think so far, and again, we need to see what happens in the next couple of days because those are probably the heaviest time of the earnings season. But so far, we've not seen any risk at all to the current quarter. If anything, we've seen a marginal, upgrade to some of the frontliner names, even for FY and 12. Clearly, some sectors like, capital goods have been a little disappointing, and we might see downgrades there. So I think on an aggregate basis, at least for the large cap universe, and that's where we've seen most of the numbers so far, it doesn't look likely that we'll see any significant change from FY12, Sensex EPS projections, for example. So, the 1250 range for Sensex EPS FY12 seems pretty intact for now, and unless things change drastically, either globally or even in domestic macro front, I think we'll probably be close to that from a projection point of view. I think, as I said, the issue is not so much the micro company level performance. I think the issue is more macro driven, and the sentiment seems to have taken a knock, and hence it's become a little bit of a de-rating issue rather than earnings downgrade issue. And I think so from that point of view, one needs to see what rating is applied to these numbers over the next 6, 9, and 12 months.